All right, so I would like to welcome each and every one of you to Bonex Investment Group. It's actually a small company that is located in Zimbabwe. That is where we started our operations before we took them international. So my name is Sidney Puno, and I'll be your mentor in your trading journey. But just a little bit about myself. It actually took me 4 years to be profitable in this business. I did production engineering. In some countries, you would call it industrial and mechanical, but I haven't practiced anything of that after I graduated, since I was now into trading full time. So how I came to be what I am today is not something that I can term easy. It was difficult, and yes, of course, I lost a lot of money. But with resilience, persistence, I managed to reach the point that I am today. So this is that is how I started to accumulate funds from investors and so forth. So I'm happy you consider to be my students, and I'll work flat out to push you to professional trading. So this is going to be a different structure from all that we have been doing in the past months. This class is going to be a special class because not special in terms of like the side of academics, but I'm going to be with this class for the next months, actually from January to June. It's actually some sort of an apprenticeship. So what we will discuss in the next lectures will give you an edge and definitely profit in your trading. So we are going to be taking 60 to 90 minutes at most per lecture. And as I've seen, some are actually coming in late for the session, and it will be some disturbance for those who have already connected. So in our tomorrow's session, I would advise each and every one to be in front of their screens at least 5 minutes prior to our starting time, so that we have a smooth flow of the session. So here's a small plan of how we are going to move this notion of this particular class. This is a 2022 trading plan. It's basically on the stages of how we are going to attack the year. So today and tomorrow, which is 13 and 14 December, we are going to have the full course rundown. So this is supposed to give you the idea of how we will be trading starting next year. So it's something to give each and every one of us a universal language that if I call out something, you will understand. Then on 15 to 17 December, I'll provide you with a practice assignment. So this is now to session on how we are going to be trading in the following year. Then on 3 January 2022, we are going to have our trading preparation for the year. So that is where we are going to be opening real accounts with at least $250. So this is the least amount that I would expect each and every one of you to have in use of your account. So any multiple of 250, that is 500, 750,000, even 10,000 is also okay. But you should have at least $250 in your account. Then on 10th January, we initiate trading. That is where the challenge will begin. So by challenge, we are saying we are trying to grow a small account, probably replicate what I've once done in the years before, whereby we try to grow it into something that is big and something that can actually give us tangible profits by the end of this year. Then on 15 June 2022, surely I believe that each and every one I believe that each and every one of us will have a substantial amount of capital as well as experience on how to trade even by themselves. All right, so the Telegram group that we are all in is going to be our trading flow. So that is where I will share at least 2 videos per week on the setups and the trades that we'll be looking at for that particular week. So we will learn 3 types of trades, and they are the only ones that we'll take during our challenge. So after each and everyone opens a real account with at least $250 or more, we are going to be following and trading these 3 particular trades. Of course, you might have taken a course similar to this one during the year, but we are now erasing all that stuff and starting again with this slightly updated course. So we are going to learn the 3 types of trades, and those are the ones that we are going to be following the next 6 months. So I will be trading also my small account. I will as well open a small account, and each trade that I take, I will share with the rest of the team. And each member can as well go out and trade, provided he or she spots a setup that meets our late criteria. So that is the reason why we are starting with these 2 lectures, so that we lay down the criteria of taking a trade, the criteria and quality of a setup that we would want to follow. So this is not a get-rich-quick scheme, right? Someone may think that we are going to spin these $250 into 1,000 or into 20,000. That is not possible in professional investment. So we would say it's not a get-rich-quick scheme, as we will be in an apprenticeship to become professional traders who can trade by themselves. So we are starting on these lectures. After those lectures, we'll go through a continuous mentorship whereby each and everyone will be seeing how we take trades as well as take them on their own account until they can replicate that over and over again. So that is why I've said this class is a bit special, since I will be with you all the way. I would ask everyone to mute their mics so that we won't disturb others. Please mute your mics. So I am going to assume that everyone knows the basics of Forex trading, as this is an advanced course. So by basics, I mean understand the basic Forex terms like stop loss, take profit, as well as undertake the basics, the basic MT4 or MT5 operations. Of course, all that can be done on MT4 can also be done on TradingView. That is, if you use TradingView. So this has to be made clear, the truth about Forex trading. I have to make it clear here before we go any further. If you are not serious, this will never work for you. So it needs more than this course. By more, we are saying it needs seriousness, the zeal to become successful within this business. So signing up for this course means you are tired of going in circles probably, and now you want to see results. I understand that there is a more than 50% probability that some of you have been losing money and also have been blowing accounts. So the results can only be seen if you trust the process. So trusting the process means doing the same thing over and over again, whether a loss or a win. So whatever we are going to talk about does not guarantee 100%, but it guarantees profitability. Profitability comes from repetition of the same steps over and over again. So whatever we are going to talk about, make sure you understand it. Of course, you might not understand within this first run of the slides, but afterwards you need to watch the video again and again, probably to fully understand it. So I hear some others are saying they do not have sound, others are saying they do have sound. Uh, you need to check your internet connection, probably. All right. So here's a summarized course outline. We are going to first talk about market analysis steps, what we will be doing each and every time we want to reach a point where we are going to give a verdict of whether a pair is going to rise or drop. Then we are going to talk about bias determination A, which is EMA simplification theory. Then bias determination B, which is levels, and uh, research concepts. Then these first three are a bit long because we are going to have more examples on levels. Levels are actually a backbone of our trading methodology. Then we will talk about traders dynamic index, which is a confirmation too. Then the three types of trades that will remove all the noise, what we will look for whenever we go on the charts. Then trading psychology, then small account money management. We are now talking on the $250 account growth that we will go through in next year. So this small account, as I have said, you may as well deposit more than 250, 500, 750, 1000, 1250, and so forth. So this is to simplify the risk management. You'd know that if your account is $500, it means it's going to take multiplied by 2, whatever someone who has a 250 is going to take. All right, Anes, may you try to mute your device? Then another thing that I will have to highlight is no trading system under the sun is 100%. Whatever that we are going to talk about is not 100%, and trading is all about probabilities. It will need more than the system to make it to profitability. By that, it means on your side, you are the one who is going to enter trades. Of course, I may post a video on why we are going to go long on GBP or why we are going to go short on Euro against GBP, but it is you. It is you who is going to take trades. All right, people are actually saying the sound is bad again. Hello, how is it now? All right. So the steps you take every day must always be the same in approaching the market. So that means what time do you wake up? What time do you analyze? And what time do you expect a trade? It needs to be consistent. So by more than this system to profitability, it means you need to be disciplined in taking the trades, in maintaining the risk management. All right, let's continue. So the first thing that we are going to talk about is trading routine. I would like you to, may you please mute your mic? I would like to everyone to have each and everyone uh, follow this particular. Please, may you mute your mic? Follow this particular trading routine that we are going to talk about. So like any other activity, there are steps that you have to follow whenever you're analyzing the markets. So here are a series of activities that must always be lined up before taking any trade. So the activities are planning, monitor, and then execute. So in January, whatever that we are going to trade, as I've said, I'll be the chief trader within that trading flow. Of course, I've given each and everyone an equal right to call out a trade, but that trade that would have been called out must be reached after planning has been done. That person should give us a setup of why he or she thinks that particular trade is going to play the way that he or she has mentioned. Then monitor and then execute. So we have 3 sessions, and depending on where we are in the world, they come at different times. So I would love to mention them as Greenwich Mean Time, and with that, the London comes at 7 o'clock in the morning, which is 700 hours GMT. So you would simply convert this time in your time zone on Google. It's just 7 GMT to your local time. Then the New York, it's 1 o'clock, which is 1300 hours in GMT time. So planning involves pair scouting, analysis, and creation of watch list. So on pair scouting, we are starting from a bundle of pairs. I'll give you the pairs that we'll be looking for the next 6 months only. We are not going to jump from pair to pair or from trading asset category to another trading asset category. I've said we are going to be using a $250 account. Therefore, it will not allow us to trade indices, to not allow us to trade metals and other exotic pairs. So meaning that I'll give you the proper pairs, 10 or 12 pairs that we'll be looking for. And within that, those 10 or 12 pairs, that is where we'll do our analysis. And after doing our analysis each and every day, that is where we'll create what we call a watch list. So after pair scouting, we'll then create a watch list, which is basically a list of pairs we expect to see. So from 10 pairs that I would have given you, 10 to 12 pairs, I'll give you in our tomorrow's lecture, the pairs that we'll be looking for in 2022. From these 10 pairs, we analyze and probably remain with 4 or 3. So from these 4 or 3, this becomes our watch list. So we need to clear everything from our terminals. By that, we are just saying now need to focus on 4 or 3 pairs that we have segregated from the bunch of 10 or 12. After a setup is issued, we will then execute. Then that setup must have reasons that we are going to talk about. So we have said we start with 10 or 12 pairs on our terminals. And from those 10 or 12 pairs, we now want to have a few pairs that we are going to put on our watch list. And to do so and be able to segregate those pairs from that bunch, we need to analyze. So analysis now looks at bias determination, right? Then setup and then execution. So bias, setup, and execution now falls in analysis stage. Analysis must always be done 30 minutes before session opening. We must not analyze the market after a session is opened, since we may be trapped with session changeovers, fakey moves, and so forth. We'll talk about that in our tomorrow's lecture. Then a setup is expected after session opening, where after London or New York has actually opened. So before we go any further, we do not allow trading the Asian session. We'll talk more about that in our tomorrow's lecture. So a trade must be taken in line within the session, sorry. And with that, let's now dive deep, dive deep in bias determination. As I've said, for us to create a watch list, we need to analyze. And for us to call ourselves analyzing the market, we need to get the bias of the market. Is it going up or is it going down? And then find a setup within that bias and then execute after a setup has been issued. Right. So within analysis or within bias determination, we need to know that there are several time frames, and each and every time frame is actually important to us. So the H1 time frame is actually the median time frame, meaning that it's a time frame that is in between being a high time frame as well as being a smaller time frame. So all time frames below H1 are called the strike zone time frames, and the ones above are called the directional bias time frames. So below the H1 we have M30, we have M15, M5, even the M1 time frame, and above we have the H4 time frame, weekly, daily, monthly. So to successfully catch proper trends for both short and long term, we need to incorporate higher time frames. So all smaller time frames are building blocks for the higher time frames, meaning that the smaller time frames are on an agenda of building what will be seen on the higher time frame. Therefore, what we enter on smaller time frames must be a support of what we want to achieve on the higher time frame. So if we want if we are going down on the higher time frame, it will be wise for someone to actually enter a setup on the smaller time frame that is supporting this particular bias. So the bias time frames, as I've said, includes the monthly, weekly, daily, and H4. And we use these to see where the market is actually going. Then this becomes the fundamental starting stage of our market analysis. We need to start on higher time frames, right? And then go on the smaller time frames, lower time frames, to find the setup that supports whatever we want to achieve on the higher time frame. Then the strike zone time frames, we have the M15, which is the best strike zone time frame, and you would see that most of our trades will be taking them using the M15 time frame, actually in support of the bias that we have seen on the higher time frame. So this is the time frame that allows us to get involved in the market moves, and entries on these time frames must always be in support of the higher time frame bias. So always know that whenever you approach any trading asset, the market maker method can be applied to anything that is tradable, except those simulated indices like the volatility indices. Actually, all the synthetic indices, they are simulated by a computer program, and they do not have news and trader psychology incorporated in them. It's a bit difficult to apply the market maker method, but anything that follows the principle of a financial tradable instrument can be traded with the market maker method. So that means you can acquire bias with the levels and the EMA theory if you are trading indices, normal indices, that is US 30, US 500, and so forth, and current pairs, all current pairs, you can trade with this particular methodology. So before we start talking about the EMA simplification theory, we need to define the EMAs that we apply. And if you have been following all the videos that I've given out, you've seen that I use these EMAs, but on most free videos, I do not dive deep on how you apply them and how you actually make this a tradable system. So in institutional trading, which is basically the market maker method, we use 5 EMAs, and they are all important in our trading. You see why they are all important. So these are the 5 EMA, which will be in yellow, the 13 in red, the 50 in light blue, the 200 in white, and the 800 in dark blue. So still on that, let's actually see them on the charts. Right, so here, this is just a template that can be created even on TradingView. We have the one in yellow is the 5 EMA applied to close. The one in red is the period 13 EMA applied to close as well. Then the one in blue is period 50 applied to close, period 200 in white, and in dark blue is period 800. So they are all important in our trading. Why? Because as you can see, this 800 EMA, this is on the M15 time frame. If we go on the H1 time frame, we can see that that same 800 on the M15 on the H1 it's now 200. And if we go on the H4 time frame, we can see that it's now 50 EMA. So that is why they are all important. They shift as we shift the time frame. So we will be trying to analyze the market with all time frames in one chart. So let's continue. Right, so after knowing those EMAs, to use them, we have a theory. And this theory states that whenever a lower period EMA crosses a higher period EMA, price pulls back to the higher period EMA after completion of a cycle. So what we are saying here is, if we see a smaller period EMA making a crossover with a higher period EMA, we expect to see the market come back to the higher period EMA and continue. But there is a condition for this to happen. We need to see a cycle completion. So if a cycle completes from this point to that point, we will need to see the market come back to the higher period EMA. So this holds in all time frames. And this is the concept that forms the basis of resets. And we will talk about resets in our tomorrow's lecture. So we are saying whenever we see a smaller period EMA crossing a higher period EMA, we expect to see the market come back to the higher period EMA, provided the cycle has been completed. We'll talk about the cycle just a few slides away. So an example would be to say, if we see 13 crossing 50 EMA on H1 time frame, we expect to see the price come back to the 50 EMA, but provided the cycle 3 levels which we will define has been issued. And another example, we might see a 200. 200 is actually a smaller period EMA crossing a higher period EMA. In this case, this is the smaller period, this is the higher period, and crossover of the 200 and the 800 on the H4 time frame, we'll expect to see the market come back to the 800 period EMA, provided the cycle has been completed. So please grasp this, because we are going to use it and apply it. So what we are just trying to say is, this is on the weekly time frame. On that particular weekly time frame, what can we see? We had a completion of the cycle, and by completion, it's unfortunate that we haven't defined a cycle, but this is how a completed cycle looks like. We had 1, 2, and 3 levels of drop. Within this drop, we had a 50, 200 EMA crossover on that particular weekly time frame. So whenever we see a smaller period, in this case the 50, crossing a higher period, which is the 200 EMA, we expect to see the market to come back to the higher period EMA. So we had the market come back to the zone of the 200 EMA, since it is the higher period EMA. So for it to fully function, we need to define what levels are. So levels are defined as market impulsive moves after a consolidation or price pullbacks. So I've taught several students. Some have found levels a bit difficult, but for you, it's going to be a different thing. I would love each and everyone to fully understand how to count levels, because if you do so, you'd see that we'll be able to catch more trades that will play out the way we expect them. So these are the manipulative moves available for the market makers to book their profits. So still on that, we know that within the trading industry, there are some people who have access to large amounts of capital. If any one of you can open more than 1,000 lots, would say he or she has the power to cause shifts of demand or supplies of either of the currencies in their pairings. So if you have access to large amounts of capital that can allow you to open very big contracts within the market, you are able to move the market at will. It costs 10,000 lots to move the market with 1 pip in any direction of your choice. So if you can do that, it means you can play like a market maker. But in doing so, of course, you need to learn the hedge funds concepts, how to trade that kind of a big account, otherwise you lose it. So the market makers can move the market at will. They can push it up, they can push it down, provided they are doing this in support of the fundamentals behind the economies of the currencies that they are shifting. So I'm sure you've came across one saying that states, the news is released to the public after its effect have been issued. Have you ever asked yourself who would have heard about the NFP when those spikes are issued? That means there are some people who have access to that information earlier than each and every one of us. So in doing so, it means there is a small elite group of traders within this industry that are there to take money, and the ones that are the money donators are the retail traders. So these market makers actually convince traders to take positions, which they will then counter, hit the stop loss of their contracts, and collect those funds as liquidity. So in doing so, they will leave prints on the markets, which we can as well try to create a system out of it. So that is how levels are coming to place after each and every rise or drop that they do, basing on the fundamentals of the economies of a particular currency. They are deemed to stop increasing a particular rise. So it means they have to rise and pull back or consolidate as a way of stopping this rise, because there are external authorities that governs how these prices are shifted. So with that, we have impulsive rises or impulsive drops, and in between those impulsive rises or drops, we have consolidation or price pullback. So for the sake of those who have never heard about the subject of levels, what we are saying is we have a push from the market makers side. That push probably will involve the market makers as well as some retail traders. And after that push, the the International Monetary Fund, which is one of the authorities that governs how these prices are shifted, would say per day you are going to shift with a maximum of 200 or 220 pips. So after that average daily range is reached, they will need to pull back or they will need to consolidate. So this consolidation is now to convince traders to take shorts, some actually taking longs, and after having several contracts within this range, right? They will see if it's profitable to give a spike down and increase, or just increase away if the shorts, if going long is beneficial for them. So that is how we have these impulsive rises and drops on the charts. So being able to count these levels will actually give you more probability of winning most of your trades. So levels exist in all time frames. Even the M1 time frame, they exist levels. So I've been trading the M1 time frame, especially if I'm trading indices like US 30, US 100. I would use the M1 and the M5 time frame, but we are not going to do that on these small accounts. However, smaller time frame levels are building blocks of the higher time frame. So whatever levels that are going to be issued on the H1 time frame, it's trying to actually build the H4 time frames levels, or the daily time frame levels. So mastering the concept of drain levels, one will have some sort of predicting power of the market. That is why I was saying each and every one of us, please try to put in the effort to understand this subject. From 15 going forth to 1 January, a period whereby we can ask each other for help. Again, sorry, someone is now saying the sound is bad. How about now? All right. Okay. So mastering the concept of drain levels, one will have some sort of predicting power of the markets. So that's what I would love to see each and every one of you doing. So each time price moves down a level, they can be referred to as achieving or making either a level 1, level 2, or a level 3 move. So to understand or remember how the markets move, we say after a big drop, the market must chop, meaning that after a drop, right, as we've said, the market makers will need to chop to accumulate new contracts and so forth. Then after 3 days of drop, the market must also chop. After a big rise, the market needs more guys, right? Consolidation to accumulate more contracts. After 3 days of rise, the market needs more guys as well. And at level 3, we stay almost forever in consolidation. So this just means after a rise or drop, the market needs more liquidity, as I've just said. So no matter the time frame, levels are combined in threes to form a cycle. What we call a cycle is basically a link of 3 impulsive rises. We have first impulsive rise, pullback, second impulsive rise, consolidation, third impulsive rise. If we have 1, 2, and 3 impulsive rises, we would say we now have a complete cycle. So a cycle will need 3 impulsive rises of rise or drop. That is where we term a cycle. So 3 impulsive moves separated with consolidation or a pullback gives us a market maker cycle. Therefore, we have to respect the fact that a complete cycle comes after 3 levels are issued. So to win in the market, you should only take a long position or a short position when the low of day or high of day is clear. So we'll talk about this stuff in our tomorrow's lecture, where we define how to see the low of day and the high of day. So this is a template, levels template of the H4 with H1 segments. before we we talk about this, I will need to define a law on how these levels interlink with each other. So we have the daily, we have the H4, right? We have the H1. One level, right? One level on the daily time frame is equivalent to 3 levels on the H4 time frame. Then one level on the H4 time frame is equivalent to 3 levels on the H1 time frame. As we can see that one level on the daily time frame is equivalent to 3 levels on the H4 time frame, and one level on the H4 time frame is equivalent to 3 levels on the H1 time frame. So within this, we can see that the cycle on the daily time frame is just one level. It means if we have the second level on the daily time frame, we will need to have another point of restart, this one. So these points of restart is what we term a reset point. So in this case, we have this point after one daily level. It will be after 3 H4 levels, and at this point it means this is an H1 reset point. And we start again. So in this case, we would see that in 3 H4 levels, we will have 9 H1 levels. So the law states that on any time frame that you are looking at consists actually any time frame that you are looking at consists of 3 levels of the preceding time frame in its one level. So in one H4 level, if we are looking at one H4 level, the preceding time frame to the H4 level, H4 time frame is the H1 time frame. So we would say in one H4 level that we are looking at, we expect to see 3 H1 levels. In one H1 level, we expect to see 3 M15 levels, since M15 time frame is the one that is preceding to the H1 time frame. So with that being defined, let's now continue. We've said one H4 level consists of 3 H1 levels. In this case, we are viewing the H4 time frame on the H1 time frame. If we are to shift on the H4 time frame, we would see something like this. This is what we were going to see if we were viewing on the H4 time frame. And if we are to shift to the H1 time frame, this is what we were going to see. On the H1 time frame, we have level 1, level 2, level 3. We reach what we call, all right, we are getting there. We reach what we call PFH, which is peak formation high, right? Then after that, we know that the H4 cycle is not yet complete. After having one level of the H4 cycle, we need the second level of the H4 cycle and the third level of the H4 cycle to deem the H4 cycle complete. So we have another level 1, level 2, and level 3 to reach another peak formation high. Then we get a reset point. Level 1, level 2, level 3, and we reach another peak formation high, which is now this H4 peak formation high after the cycle of the H4 is completed. Therefore, in 3 levels of the H4 time frame, we expect to see 9 levels of the H1 time frame. These reset and where they occur, we are going to talk about them in our tomorrow's lecture. So we have reset 1 and reset 2 within a complete full cycle. So if this was the daily time frame, whereby we have 1, 2, 3, this was going to be the H4 time frame. If this was the weekly time frame, we expect that this was going to be the weekly, this was going to be the daily time frame. So that's how these levels interlink with each other. And to remember clearly, you just remember that each time frame that you are looking at will require it will require 3 levels of the preceding time frame for each one level to be complete. If you remember that, you'd find it easy. So before we learn how to count levels, we need to know why we do that and the reasons for counting levels. To know, all right, someone is saying whenever the market will come to the reset, I presume. So how many levels? All right, I've said we are going to talk more about resets in our tomorrow's lecture. That is where we will define how long we will need to move to reach a reset point. So reasons for counting levels are to know where we are in the cycle, to prepare ourselves for market reversals, to know how long to stay in the market, as well as to get in the market. So in our 250 challenge account, we are now going to incorporate higher swing trading as well as intraday trading. And by swing trading, we are saying if we catch a very good peak or a peak formation low or a peak formation high, we will need to hold that trade for the number of levels we anticipate to see the cycle completing. So that is where we would say we need to know how long we are going to hold our trades. So to properly count levels, we need to start at peak formation low or peak formation high. This is the lowest or highest point of the previous cycle. So the previous zone of reversal is also a point of starting our levels counting. So I'll actually show you over the charts after we finish these slides. Right. So before we start this part, I would say we may have a small 5-minute break. It's just a water break. And then we will start from this hex in counting levels and we jump over the charts. So we are going to take a little bit longer on the charts so that each and every one of you understands how to count these levels. So what I'm going to do is we are going to just pause and have a 5 minutes break and come back to finish off our today's session. Right. I hope we had just a freshening up moment. We are now going to continue with levels counting. So before we start the real counting, we need to highlight the hex in counting levels. So as I've said earlier, that for a complete full cycle, we have 9 levels, like 1, 2, 3, get to a reset, this being a peak formation high, a reset point. We start again, 1, 2, 3, peak formation high, reset, 1, 2, 3. We complete our cycle, and probably we have an ultimate reversal, to a reset. If this is an H4, we would say we have 1, 2, 3 levels of the H4 time frame, and this will be a reset on the H4 time frame. So after these 9 levels going up, we would say we have the first cycle of levels, which is this one, the second cycle of levels, and then the third cycle. So in the first cycle for level 1, right, level 1 for the first cycle, we can see level 1 with a 1350 EMA crossover, but we need a corresponding rise. So after we see a rise and a 1350 EMA crossover, we can say that level 1 has been issued. Level 2 can be seen by a 50-200 EMA crossover, a 50-200 EMA crossover, and a corresponding rise in this case. Then the level 3 can be seen as a rise, impulsive rise, after price is bounced on the 13 EMA or 50 EMA. So these are for the first cycle. We need to see level 1 with a 1350 EMA crossover, level 2 with a 5200 EMA crossover, level 3 with a 13 with a bounce initiating as a bounce on the 13 or 50 EMA. Then after reset 1, all right, someone is saying he couldn't understand. Let me repeat it again. All right. So we are saying for level 1, we need to see an impulsive rise, right? An impulsive rise, and we need to see a 1350 EMA crossover corresponding to the rise. Then after that rise, pull back or we consolidate, level 2 can be seen with a 50-200 EMA. It occurs just before or in between or just after the level 2 impulsive rise, right? Then level 3, price will need to pull back, right? And retest the 13 EMA or the 50 EMA, right? And then continue to go up. Therefore, level 1 will see it. This is to simplify how we count levels. Level 1 will have a 1350 EMA, level 2 will have a 5200 EMA, and level 3 will start as a bounce on the 13 or 50 EMA to go up, and we reach the peak formation high. From there, we go to the reset number 1, right? So this is first cycle, and we are now going into the second cycle, right? So in the second cycle, we say level 1 in the second cycle, which is this one, level 1, level 2, and level 3. We need to see level 1 with a corresponding 1350 EMA. Therefore, a 1350 EMA will occur for level 1, and then level 2 will start as a bounce on the 50 EMA, 50 or 13 EMA at this point, and then level 3 will also start as a bounce on the 50 or 13 EMA as well, right? So that is for level for cycle 2, which is after reset 1. This is reset 1, and this is cycle 2, and this is cycle 3. Then on cycle 3, the same conditions that apply for cycle 2 will also apply on the third cycle. On the third cycle, level 1 will have a 1350 EMA crossover. Level 2 will have a 50-200 EMA crossover. And level 3 will have, level 2 will start off as a bounce on the 13 or 50. And then level 3 will also start off as a bounce on the 13 or 50. So you actually fully understand this when we go over the charts. So what we are saying for level 1 is first drop or first impulsive drop must have a 1350 EMA crossover like this. This is a sign that we are in level 1. So it might not be as perfect as how I've said it. If that was so, we could have programmed robots that were going to count levels for us. So level 1, we have a corresponding drop and a 1350 EMA crossover. Then level 2, we have a corresponding drop to the 5200 EMA crossover, right? Then level 3 will actually initiate as a bounce on the 50 EMA. It might be 50 or the 13 in red. So either this or this will give us a start or an initiation of level 3. Then after this has been done, that is when we would see the market approaching the higher period EMA, which is the 200 in this case. So this is for the first cycle, 1350 crossover level 1, 5200 crossover level 2, bounce on 50, level 3, bounce on 50, then level 3 flow. Then second cycle, we've said we have this as our reset. In this case, the trend was going down. This is a reset. Someone is saying he's out of the meeting. So level cycle 2, we have a reset, and after that we have a bounce on the 50. It might be on the 50 or the 13, right? Level 1, 50, 13 crossover. Level 2, start as a bounce on the 50 or 13. Level 3, a bounce on the 13 or 50, and we are done. So whatever happens, actually these conditions will also apply in the third cycle of the market. So we are now going to the analysis of the market. Everything that we have said now needs to be applied on the market. So these are the steps that you need to follow each time you count your levels. All right, so the first thing is to mark the immediate high, weekly high or low, right? It means we are going to start on the weekly time frame, right? We mark the immediate weekly high or low. In this case, we now need to apply or use our logic. Is this weekly high or low signifying as a point or as the highest point or the lowest point on the chart? After that, we go on the daily time frame and start to look for impulses, right? On that particular daily time frame, we know that one daily level, there should be 3 H4 levels. So is the daily cycle complete or not? If yes, it means if the daily time frame is complete, we now need a reset. If the daily time frame is not yet complete, we now need to continue with our levels until it's complete. It might be difficult here. I'll show you on the charts. Then in one H4 level, there should be 3 H1 levels. How many levels are in this H4 level? Those are the kind of questions that you will be asking yourself. That you will be asking yourself, how many levels are left to reach level 3 and so forth. Right, so let's jump over the charts and have examples of how we count our levels. So we've said the first thing that you need to do, this is MT4, you may be on TradingView. The first thing that you need to do is to go on the weekly time frame. And this is where I am right now. Look for the highest immediate, highest or lowest point. So in this case, we have, is everyone having the same problem of screen freezing?
Nah.
All right.
Nope.
No.
Perfect. All right.
No.
We may
No.
continue. So the first thing is to see where the market is coming from. Where the market is coming from, the highest point in this case is this one, right? On euro against dollar. This is the highest point where the market is coming from. It's the immediate high on the weekly time frame. Therefore, we are going to start counting our levels on that immediate high. In this case, what we are interested in is to look on this. Let me pull my chart. What we are interested in is to look on our right? So on our right, we are going to analyze whatever is happening on this part using the smaller time frames. We started on the weekly, we are now going on the daily time frame. So on the daily time frame, this is what we see. This is the highest point that we have drawn on the weekly time frame. From that highest point, we can see an impulsive drop, right? This impulsive drop has a 1350 EMA within it. From that impulsive drop, we can see that the market was making consolidation in this area, right? Therefore, a level is a net drop that should break the low or the high of the previous perceived level. In this case, we had a drop, right? A 250 EMA crossover, but then the drop was issued at this point, which broke the low of the first level. Then after that, we can see the market pulling back to bounce on the 50 EMA at this point, and then it went down. So when counting levels, we need to mark them so that we see what is happening within the cycle using rectangles. Therefore, this was the first level, first drop plus its consolidation, right? That's one. Then second drop plus its pullback, that's two. And then the third drop. So after having this, we would say the market has completed its cycle on this daily time frame. What is now happening next? All right, I'll take questions later. What is now going to happen next? We can see that there is a 50 200 EMA here. A 50 200 EMA after a cycle is completed will actually tell us that the market will need to pull back to the higher period EMA, 50 in blue, 200 in white. So we are expecting to see the market come back to the higher period EMA like this. So on the daily time frame, we have built bias. What are we expecting? We are expecting to see EU going up to the higher period EMA and then continue going down. So our reset is going to be at this point. So within these levels, that is where we were saying, if we look at the preceding time frame, we should see 3 levels of the preceding time frame. So if we go on the H4 time frame, we need to see 3 H4 levels within this drop. First cycle, second cycle, third cycle. So going on the H4 time frame, this is how it looks like. And on that particular H4 time frame, we can see some consolidation. The crossover of the 1350 was this one, the last one. There were several crossovers, the last one. Then the first impulsive drop, a bounce on the 13, the second impulsive drop, a bounce on the 13, then the last impulsive drop. Therefore, if we are to count or mark levels on this H4 time frame, we are to say this is level 1. You may differentiate the colors so that it will be more clear. Level 2, and then level 3. Why were we saying level 1 had a 1350, level 2 a bounce on the 13, a bounce on the 13? Because this is the third cycle. So in this case, what are we now expecting? From the bias that we have attained from the higher time frame, which is the daily time frame, is that the market is going to go up, and whatever we are going to enter should be in support of this daily time frame bias that we have attained. Therefore, the patterns that we are going to be looking for within this region should be in support of the bias that we have attained on the higher time frame, and the patterns are the ones that we are going to be talking about in our tomorrow's lecture. So let's have another currency pair and try to mark levels. In this case, this is a pound against dollar, and the first thing that we have said, whenever you are given any chart to analyze, you start on the weekly time frame. On that weekly time frame, we need to see the immediate high of that particular weekly time frame, and it's this one in this case. So this is all right. Someone is saying, so level 3 has bounces, not crossovers like level 1. Yes. Why do you use the high and not the low? All right, I was saying the immediate high. In this case, we have this low, we have this high, the immediate high of the weekly time frame, right? Sometimes, if in this case, if there was a small flow, we were going to consider the immediate low of the weekly time frame. But the immediate turning point of the weekly time frame is where we consider as our point of starting our analysis. In this case, this is the immediate high. The price is here. It's coming from this point. In the previous peak, we also had a peak, and the EMA cross. Why did you start with the other 13? All right, let's just finish off, guys, and I'll give floor to questions. So at this point, this is the first point, the immediate high. Then we go to the daily time frame. On the daily time frame, what can we see? On this particular daily time frame, we can see that we had a flow of the market, right? From this high where we had a 1350 EMA crossover. Then the next point, we can see that the market was actually in a consolidation, right? Consolidation. Where can we see a 5200 EMA crossover? It was issued here. Then where can we see the market bouncing on the 50 EMA? We can see it bouncing here on the 13. We expected it could bounce on the 50 or on the 13, right? This is now a little bit difficult example. We had a 50 to 13 EMA crossover for level 1 consolidation, equal tops, and equal bottoms. Then we had a floor which was later countered to clear everything that was issued. Then the break of this low was done up to this point, and then price bounced on the 13 EMA to go down. So in this case, we are expecting to see the market come back to the higher period EMA to give us a reset like this. But that can only happen if the cycle is completed. So is the cycle complete? That is where we start to count levels, right? In this case, we are going to say we had level 1 and its consolidation, right? Therefore, in this case, the consolidation are too big. Then level 2 to the bounds of this, and then level 3. And whenever you see levels being difficult to count on any pair, please do not confine yourself to be a master to try and break that chart. In this case, we have 1, 2, and 3, and we need to confirm if this level is now complete for us to see the market going back to the higher period EMA. And we can do so with the H4 time frame, right? On the second daily level, right, we can see that there was 50 13 EMA crossover, which had a corresponding drop, right? A bounce on the 50, a drop, a bounce on the 50, another drop. Then we had a reset. From there, we had the first drop, a bounce on the 50, the second drop, and this is now a bounce on the 50. Therefore, we can say that we have the first level, the second level, and then the third level that we are now expecting on pound US to go down, so that the cycle will be complete. All right, let me check the questions. All right, so this is what we are expecting. If we are to go on the H1 time frame, this is what is happening on the H1 time frame. We can see that in one H4 level, we expect to see 3 H1 levels. So this is an H4 level, and from that H4 level, we had a 1350 EMA crossover at this point, right? Then a retest of the 50 EMA drop, another retest of the 50 EMA drop, and we reach the third level consolidation. So if we are to mark the H1 levels within the H4 time frame level, we have 1, please try to segregate your levels with EMA bounces, especially in these choppy drops like these ones. Try to look for points where the market bounced so that you would see the levels clearly. No, I don't use ADR. All right, yes, we'll try to find one level, one example in a bullish encounter. Then we had this point. Then from that point, we can see that the market was in a very choppy drop. This was now December. And from this point, that is where we are expecting to see the market give us level 1, level 2, and level 3, so that this move that we have said on the H4 time frame will be satisfied. So levels may be difficult to see, and if that's the case, do not confine yourself to trying and see those particular levels. Then another thing is try to separate levels from each other with EMA bounces. So let's have another example. It's unfortunate that the pairs that we are going to be looking at USD index is just another instrument that can also be used, that can also be traded. So if the USD index is going up, it means the US dollar strength is going up as well. Then if it's going down, it means the US dollar is weakening. So in counting levels, we are not, we need to trade what we see rather than basing on correlation. So this is order against dollar. The first thing is to go on the higher time frame, which is the daily time frame. Let me see if there is one, right? In this case, right? So in this case, we have the weekly time frame. Let me remove all. The weekly time frame on USD CAD is showing us that price is here. The immediate low from where the price is at is this one, right? This is where the immediate low is. Then if we go on the daily time frame, from that immediate low, we can see that we had the first cycle of the daily time frame in this point, then we came back. So in this case, we can see that we have been issued the first impulsive rise, as we can see that there was an EMA bounce. I've said if levels are very difficult to see, try to segregate them with EMA bounces. This case, this pair is a bit difficult and challenging, but what we can see is from this lowest point that we have drawn on the weekly time frame, we had an impulsive rise where we had a 1350 EMA crossover and the market bounced on the 50 EMA. Therefore, we can say that we now have a daily level. In this case, from that daily level, if we are to check for it on the H4 time frame, this is what we can see. We can see a 1350 EMA crossover here, right? After that 1350 EMA crossover, we can see a 5200 EMA crossover at this point. Then we can see a bounce on the 13 EMA. Therefore, we need to see three H1 levels, three H1 levels, three H1 levels, and three H1 levels. So if I am to mark the H4 levels on this time frame, we are going to say we had the first H4 level, and we will need to verify. In one H4 level, we need to see three H1 levels. 1, 2, and then the last one, which is 3. These are H4 levels. And after that, we can see that we have been issued a reset at this point. So we need to check if there are three H1 levels within those H4 levels that we have marked. On the first one, we had a 1350 EMA crossover, right? A 5200 EMA crossover. This was a rise, consolidation, another rise, a pullback, and then the last one. So in this case, we can see that the market is in a choppy rise but we are trying to segregate each level with EMA bounces. Try to segregate each level with EMA bounces. We had a rise, a bounce, sorry about that. So we are saying one, a bounce, two, and its consolidation, and then three, a reset. Then we restart again. This was now approaching December. So in December, usually we have more of choppiness because right now market makers are closing off positions and are preparing for the festive season and so forth. So we usually have more consolidations. And what I need to tell you is we can as well trade without counting levels. We were trying to we need to know how this is done, but we can as well trade. I know some of you may be now scared if they are going to understand this concept. Levels are a bit difficult, but with more effort and practice, you will reach there. So whatever you are trying to count levels, try to look for EMA bounces or touches, right? Try to look for the X that we have talked about, impulsive rises with corresponding crossovers, and then after that, EMA bounces and segregate them from each other with those particular bounces. In this case, no one was going to count levels because we were saying one consolidation, two, and it's now all consolidation. And the market went down to give us an H4 reset. This one. So we are now restarting our count from this point. And if we are to restart our count on the H1 time frame, we can see that we had the first rise. Why you didn't count first one? All right, sorry, it's almost time for questions. So from this point, we can see that we had a 50, a 50, uh, 50 13 EMA crossover. Then price went back to bounce on the 50, then a 5200 EMA crossover, meaning that we now have level 1, level 2, and we are expecting to see the third level. So the bias is now is actually going up. If we are to mark the levels, we may say we had the first one here, and then the second. So any setup in support of this bias is a valid setup to trade. All right, so I will now open questions, and you can as well start to use your mics. Right, someone is asking, how does news fundamentals affect levels, e.g. NFP? So the first rule that I am going to lay out, especially in our challenge, is we do not trade high impact news. If high impact news is coming, we should be already in the trade. Usually, whenever a high impact release is done, we will see the market violating the levels. You may see it giving us two levels at the same time. Actually, like in this case, you can see this sharp drop. It may be issued. So we do not trade high impact news, but if ever we were in a buy trade on USD CAD after catching this reset point, and right now we are in a trade expecting to see 3 levels going up, and news is coming on the 3rd level. We may be in that particular, we may remain in that particular trade, because usually when news comes within cycles, it's there to complete the cycle. And someone is saying, what are the indicators you are using at the bottom of the chart? So this is called the TDI, and we'll talk about it in our tomorrow's lecture. It's a confirmation tool of where we are going to talk about the setups that we look for in line with these biases, and then use the TDI to confirm those particular setups. So don't worry, we'll talk about this TDI in our tomorrow's lecture. All right, please count the levels in the last box. You mean on USD CAD? All right, that is where I was saying. In counting levels, we are going to follow rules. And the rule that we are going to follow is, are there impulsive rises separated to each other with the consolidation, or separated with EMA bounces? As I've said, if something is like this, and this actually happens within the market, you must not be a master to solve everything. This is an inexplicable behavior that is sometimes issued within the market. And if this is the case within market flow, we'll usually leave out that particular pair. In this case, we can see a first rise, right? But from this first rise, can we say there is anything that we can see on this market flow? There was choppiness and consolidation. But on the H4 time frame, we can see it's actually a rise. But within the H1 time frame, we cannot, no one can count levels within this particular move. So before reset inside the level 2, we have 2 times we have 2 times 50 EMA bounds. So why didn't you count the first EMA bounds as well? This case, we had the first one, right? Then we had the second one. From this high and this high, they are in the same region, right? Let me they are in the same region, like this. Therefore, this was a rise, a pullback, a rise, a consolidation, then another rise. That is why we could not say these are 2 different bounces. So we had 1, 2, and 3. Are there any more questions? All right, do we use exponential or simple moving averages? We use exponential only. We use exponential moving averages only. All right, so the system is not yet complete. Do not stress your, or for use, I use FX Street. FX Street is easier because it also has alerts that so we need to break high, our last high. Yes, for us to dim a level, we need to break our last high or last low. So the system is not yet complete. You may start to worry or to be scared if you are going to apply this. We need to incorporate some other concepts that we'll talk about in our tomorrow's lecture. So do not worry. So we start the weekly. We start on the weekly, the drop to the daily. count the levels and look for EMA cross. Correct. Weekly time frame is where we find what we call the weekly time frame is where we start, and that is where we find the data point. All right, it's FX Street. All right, someone is saying that they need another pair. All right, I don't know if you have one in mind, so that we have it new for both of for all of us. All right, we have GJ because as I've said, we are not going to be trading US30 in our challenge. So the first thing that we do, as always, is actually to start on the higher time frame, which is the weekly time frame. From this point, we can see the highest, immediate highest, which is this one. All right, the video will be available as soon as we finish. Actually, it will take 20 to 30 minutes to convert into an MP4 file that is shareable on Telegram. Then we go on the daily time frame. What can we see on the daily time frame? We can see an impulsive drop, we'll make another impulsive drop, right? So if we are to mark levels on this, so another thing that someone may ask is, we don't see a 250 EMA crossover. What is important is an impulsive drop. That is why the EMA crossovers are hacks. They just are there to help us see what is happening within the market. So in this case, we can see what are we expecting in this case? The daily cycle, not yet complete. Therefore, we anticipate to see that daily level like that. So going on the H4 time frame, on the H4 time frame, you can see one, it was a bit dirty. Try to mark it. Someone is asking the same thing that I've just said. I've said they are only hacks, right, that are there to guide us. So in this case, we can see a 1350 EMA crossover, but then we don't have enough levels. Probably in this point where we had these drops, that is where I was talking about. We usually had a news release in this point. And whenever we have news releases, we are likely to have compressed levels that cannot be counted, fast moving levels. In this case, we had a drop that and another drop this. So we might say this was a level, but if we check this one on the H1 time frame, we would see it incomplete. Therefore, we had two levels within this particular one daily level. Then the market went back to the higher period EMA, which is a reset point. From there, we anticipated to see again three levels of the H4 time frame. But in this case, we can see, yes, the template will be shared with you in our after our tomorrow's lecture. And from this point, we can see that we also did not have three H4 levels. But what we can see is we are anticipating to see markets drop to give us the third daily level. Therefore, of course, we cannot count levels and break them down on this time frame, but what we can see is that we are in a downward bias using the daily levels. So whatever we are going to enter on GBP JPY must be a drop. In this case, we had this big setup, which we'll talk about in our tomorrow's lecture, and we should be right now, we should be in short on GU and GJ. So we'll talk more on the setups to follow whenever we have found our bias. So in this case, this was not a viable because it's not issuing enough levels as we anticipated. As you can see, we had two levels. In this case, we had also two levels, one drop about 13 and the other drop, and we are now starting to give to move for the daily time frame. So levels will require logic. By logic, we are saying somehow you'd see that what I draw may be different to the other person's levels. Why? Because it's something that is a little bit subjective. So that is why we need to respect bias. Bias plus setup is equal to one thing that we can talk of. So bias, I've showed you how we attain bias. The EMA theory, whereby we need to complete the cycle for us to come back to the higher period EMA, plus setup in line with that bias, it will be a perfect trade. I don't know if there are any more questions. All right. All right, so we have come to the end of our first session. I'll post this lecture in our Telegram group, and we can rewatch it. And if you need help, you may post directly to my inbox, and I'll get back to you. Thank you very much for having you on our first lecture. Someone is saying, but on the daily 50 didn't cross yet. All right, I'm sure you can rewatch again, because some other people are keeping on they are keeping asking the same questions over and over that I would have explained. All right, thank you so much, guys, and you are going to be my family for the next 6 months. And don't worry if you haven't understood this stuff. So the first time, we are going to, especially in January, I will be sharing more setups and more explanations on why we'll be taking trades. In this case, we can see that most welcome. I can see everyone is happy. All right, so let's meet again tomorrow, same time, and I'll actually share the same the login details 5 minutes prior to our starting time. So please be on time so that you won't disturb others. Tomorrow's lecture is more important because that is where we actually get or learn about setups that we need to take in line with our bias. So thank you so much. Have a good day from wherever you are.
Thank you, Sydney.